How did a cookie store and French bakery merge to create a $7 billion restaurant empire? That's exactly how Panera Bread was born, which today has over 2,000 locations and is worth a whopping $7 billion. So we're going to go over the 7 key moves that made Ron Shaich, the owner, a billionaire, starting with number 1, letting your customers break the rules. When Ron was starting what would become Panera Bread, he had a different vision for it. He originally envisioned a high-end cookie store called The Cookie Jar, which was next to a French bakery called Au Bon Pain. Au Bon Pain was an unusual French bakery in that they made super high-end French pastries and bread as a way to demonstrate their superior baking equipment, and then they would sell their baking equipment to their customers. Now here's where things got interesting. Ron's cookie concept wasn't really taking off at first. His cookies around the afternoon would sell like hotcakes or in the evening, but he had no breakfast business, which was super inefficient and a huge problem in his concept. So he started carrying some items from the French bakery across the street to do more business in the morning hours with those items. He brought in the breakfast croissants and French breads for breakfast. He noticed his customer base starting to act very strange in sneaking in deli meat and then starting to pull apart his bread in front of him to make sandwiches. They would even sneak in their own coffee because they loved his bread quality and high-end cookies, and they wanted to pair those things with more wholesome ingredients to create a better meal. When Ron saw this continued success, he came up with a bold plan to merge with the French bakery and take advantage of this customer rule-breaking behavior. He renamed the new concept Panera Bread, creating the first ever bakery cafe known for its extremely high quality bread. And that's when things absolutely took off. The lesson here for us is to try to learn from even annoying or weird customer behaviors. When I was first getting started, I think I'd be offended if I saw customers bringing in food to my restaurant, and I'd try and ban that because in my mind, them bringing in food would mean less revenue for me, like my concept was being violated, and no restaurant allows that in the first place. But Ron didn't do that. Instead, he became curious. He saw his customers sneaking in those meats and pulling apart his bread in front of him to make their own sandwiches and asked himself why. He realized that it was because those things paired really well with the items that he had, and that this could be the ultimate way to expand his concept and drive a bigger breakfast and lunch business. That's when his concept really took off. To give you another example, I just saw this happen in my business, where we have thousands of restaurants using our platform, and we were previously giving them a flyer-based system to try and drive more people to their online ordering. Yet I saw some customers not using those flyers and instead opting to put gift cards into go bags and drive customers that way. At first I was surprised about why they were using an entirely new system, but then when I saw the numbers behind their success, I realized that they just hacked our system to find an even better way, and that it would be in our best interest to learn from them and distribute this across our entire customer base rather than trying to tell them, no, don't do that thing that our product is not supposed to do. You've got to use it in the way it was intended. The best way to use this is to notice when customers are doing unexpected or weird things in your concept. Whether it's an unusual seating pattern or unusual hours that they're in your restaurant or unusual combinations that they're ordering from your menu. Rather than telling them, no, don't do that. That's not how my concept was designed. Getting curious at first about what unmet needs they're actually meeting through that weird behavior and figuring out whether there's ways that you can use that behavior to drive product innovation to make your concept even better. Another great example that I've seen of this is what certain pizzeria owners notice about Sunday orders. Most orders throughout the week are moms ordering for their families. The orders on Sundays are different. They're actually men that are ordering pizza to watch football with their friends. And unless you were paying careful attention to this deviation, it would hide the opportunity that Sundays present for pizzerias, which is having specials that are designed for game day. And the pizzerias that end up implementing those specials on their menu, because they're noticing this customer behavior, have an inherent advantage in being able to reach those customers and personalize an offer that makes sense for their circumstances. When Ron adapted his concept to match the customer behavior that he was seeing, he started to see huge breakout success. His initial unit ended up reaching millions of dollars in sales volume and becoming a regional legend. People were catching on to what was successful about Panera Bread and wanted to open their own. So he started getting inundated with inbound franchise requests. That was exciting, of course, but it also led to Ron avoiding the trap that killed Quiznos through lesson number 2, making it harder to get accepted as a franchisee than it is to get into Harvard. Wait, making it harder to franchise than it is to get into Harvard, wouldn't that actually kill your ability to expand? I would think so too, but I've now seen thousands of restaurant stories up close, both the ones that I've worked with directly and in studying some of the biggest restaurant successes of all time, like Subway and Quiznos. And I see so many of them make this mistake that ends up killing them, which is that they see franchisees pounding down their door and then they let anybody franchise their concept who has the right amount of money to expand their locations. It sounds good in the short term, more income, higher franchise fees, more locations, but it ends up jeopardizing the value of that brand in the market as these inexperienced operators that are kind of passively checked out end up taking on their new locations and destroying their reputation. So that's why Ron took the opposite approach. Instead of telling all of these millionaires who wanted to bring Panera Bread to their city, absolutely, you can, he instituted the most rigorous set of qualifications that the industry had ever seen for franchisees and treated interviewing them like interviewing for a leadership role. This is why Panera Bread only had an acceptance rate of 0.25% from the beginning, making it more than 10 times more selective than Harvard, and that's even with ensuring that every application comes from a millionaire that has at least $3 million in cash to open a location. He also made an unusual rule, which was only targeting franchisees who could eventually operate multiple units so that they could grow with him, using the profits, continue to invest that more and more into more franchise locations rather than having single unit operators that can be harder for franchise systems to manage. You may be thinking, did it kill the amount of franchisees that Ron got? And the fascinating thing here is no. Not only did it not kill him, the exact opposite thing happened, because word started to spread in the communities of franchise investors about how hard it was to open a Panera and how profitable the brand was and how good the numbers were because they had all of these expert operators running them. And it led to the very best people being interested in opening a Panera because the average stats were so jaw-dropping. The average Panera store profits more than $400,000 a year, which is more than double the equivalent McDonald's. This is how they've grown into a 3,000 unit brand relatively quickly. So, what are the practical takeaways in lesson 2 of how Ron made Panera so hard to break into as a franchisee? It turns out that his thinking isn't just specific to franchisees. It's also how he thinks about building teams and how all of the most successful restaurant owners think about building teams. Rather than taking the first qualified person that has the right experience on paper, they carefully filter each new teammate for being what is called a cultural fit and enhancing the working experience of the other employees of the restaurant and how they're going to engage with guests. And they make it super difficult to get a role in their restaurant because they know that as they hire a manager or a supervisor or even just an entry-level server, that those people have a massive influence over every guest's experience and how guests think about the brand. So they take their time with each of those hires, knowing that the team you build is the restaurant you build. The other big takeaway that's related to this is being patient with expansion, knowing that the way you go fast in the long run is to go slow in order to go fast. To first carefully make sure you have the right foundation and the right people that are representing your brand, rather than just the people that seem qualified and that have enough money but aren't going to be great stewards of the reputation that you've worked so hard to build. Because as you may have seen in the Quiznos video I posted, they were actually ahead of Panera in terms of location count. They looked so good from the outside, but because they'd set the wrong foundation and were basically taking any franchisee that could afford their fee, their entire empire came crumbling down and ended with huge amounts of reputational damage, lawsuits, and ultimately a failed brand and bankruptcy. But Ron knew that the best way to go fast was to start by going slow and making sure that he had the right foundation to build on. Panera was able to take take about 10% of franchise sales or double the usual rate and use that cash in a very unconventional but genius strategy to grow about a decade in. And that was lesson 3, expanding through distressed asset buys. At this point, Ron was already growing at a good clip using the franchise model, but he realized that he needed to figure out a new expansion strategy if he was going to build a brand worth billions in the next decade. So he kept huge amounts of cash in the business as retained earnings, rather than paying out that cash as dividends, and waited for years to figure out how he could use that cash to expand with acquisitions. That time finally came in 2007, just as the markets were starting to crash, because one of the competitors that Ron had his eyes on, Paradise Bakery and Cafe in the Western US, started to struggle financially. So Ron was there and had the cash to offer them a buyout of $40 million for their 70 locations. To put that into perspective, that brand was doing over $100 million in system-wide sales and also had a great reputation doing something very similar to Panera, but in a different region where they didn't have a presence. Yet, they accepted Ron's offer. Now, here's the genius in it from Ron's perspective. If he were to have invested that $40 million into opening new Panera Bread stores in that same region, it would have only allowed him to open 20 new stores with that same amount of money. But instead, he was able to get 70 new stores, 3 times as many. And the best part was that each of those stores was already doing $1 million in sales and were mostly profitable. So they didn't even need any time to build and ramp and could immediately contribute to Panera's profitability. Getting 70 corporate-owned stores profitable in a brand new region literally grew the total value of Panera by more than the $40 million it cost them that year. So it was almost like a better than free acquisition. Like they were paying him and increasing the value of his company to give him 70 more stores that were profitable and doing over $1 million in sales. So you may be wondering, what is there to learn from this key? The first part is being very strategic with keeping cash healthy on hand for when the time is right. There's a lot of restaurant owners that are constantly distributing out all of their net profit to themselves as dividends, as profit for the year. But the problem with that strategy is when you pay it out in personal income, you end up not only having to pay tax, but it means that your business has less cash on hand for when these types of opportunities come up to expand. Because this is related to the second big takeaway, there's often great expansion opportunities through doing what are called distressed asset buys in restaurants, where there's restaurant concepts that are similar to yours in different areas that you might want to expand into that for whatever reason aren't working with the way they're executing. The usual way to expand into a new location is to open a brand new store. You can end up doing it for 10 times less through doing one of these distressed asset buys and take over an asset that already has a customer base that wants what you do, that you can do it even better for. Whether it's people who want to get out of their lease or who had emergency bills that came up that they want to pay, they'll often take way less money than the asset is usually worth, and if you've kept the cash on hand, it enables you to expand. I also saw another recent example of this in one of the independent restaurant owners that I work closely with, Enga, the owner of Matanga's Pizzeria. She had identified the cities near her in San Antonio that she wanted to expand into, and rather than forking out the hundreds of thousands of dollars that it would typically cost her to open a new unit, she did something very strategic. She set up alerts on each of the business brokerage websites like Biz Buy Sell that would ping her anytime a new pizzeria got listed. And she especially looked for deals where the owner was eager to sell for some reason and had built up a solid base of customers so that she'd be able to buy those assets for very cheap, take over the equipment, the lease, the customer base, and add her location in, executing it better in order to create a success where there were once failure. And this strategy has served her brilliantly. It's how she's gone from 1 to now more than 7 locations in just a few years and continues to expand. A lot of the most savvy restaurant operators use this strategy because it ends up compressing that cost of new location by 5 to 10 times and make it that much more efficient. By the way, if you want to continue learning about the best strategies for growing your restaurant profitably and expanding, then subscribe to this channel because every week I post a new video sharing lessons that I've learned in working with thousands of restaurants or studying major success stories, and I share them entirely for free on this channel. So if you want to make sure that you never miss out, then click that subscribe button down below. You may have noticed that Panera's been on a buying spree over these past few years. They've been all over the news for for it. And it's actually for a different reason than unit expansion that is also extremely valuable to independent restaurant owners. That's lesson 4, merging in complementary concepts. Those brands that Panera recently bought out are Caribou Coffee and Einstein Bros Bagels. You are probably thinking to yourself, what do Caribou Coffee and Einstein Bros Bagels have to do with Panera Bread, and why would that brand buy them? What Ron had in mind with this acquisition was actually what's called a synergy acquisition. That's just a fancy term for saying that the value of the combined companies is worth more than the total of each asset when they're not together. Here's why. Because it expands how much revenue Panera is able to make per customer and allows them to cross-sell both products and locations to customers of each of those units. Because it now made Panera have extremely high quality coffee through Caribou and extremely high quality bagels through Einstein Bros, in addition to their booming bread and soup business for lunch and dinner. The specific thinking in why coffee and bagels would be more important is Panera is mostly known for its lunch and dinner business. So by adding coffee and bagels, they continue to expand their breakfast offering, and we're able to use all of these established brands to also offer certain Panera products like bread and soups in those locations and sell more to the same customers by meeting more of their jobs. Even if you're just starting out and you're not at the stage where you can fund acquisitions for synergy, ask yourself, if I could buy another business and merge it into mine to grow my sales per customer, which business would I choose? Because that question can lead you to realizing that you can expand your concept into a strategic direction to meet more of your customers' needs, even without having to buy another brand to do it. If you're looking to grow your sales per customer and want my opinion on what would be best for you to expand into, then comment your restaurant name and the city it's in down below. I'll research your menu and then check out your local competitors and compare it to some of the biggest restaurant successes that I've seen of your cuisine type and get back to you in a comment with some personalized advice about what I would do to expand your sales per location. Another way to apply that thinking is to do strategic upselling that meets your customers' unmet needs. What I mean by that is you've got certain dishes on your menu that actually create certain customer needs. Like if you have a really salty guac and chips, for example, that tends to make customers thirsty. So if you can build into your ordering process that when you sell guac and chips, you also suggest an agua fresca as a taqueria, this refreshing beverage that makes customers that are thirsty feel better, then you're driving up your revenue per customer in this very strategic way that meets a customer need. Another way to apply this is realizing that if you're not covering all 3 meals a day, breakfast, lunch, and dinner, that you might be able to through strategically adding certain items to your menu that appeal to those specific needs. The reason this is so powerful is that you've already got a lot of the same fixed costs regardless of what hours you're open, because you're paying your lease and you're paying for your kitchen equipment and you're paying for the marketing of the restaurant. So if you're able to add more meals that you serve using those same fixed costs, you're able to drive up the profitability per unit. Whether that's adding a breakfast menu if you're currently a lunch place, or adding dinner if you're currently a lunch place, or adding lunch if you're currently a dinner place, you can expand your concept to meet more of your customer needs in applying this thinking. And that's lesson number 5, stickiness through subscriptions. You may remember that Panera Bread was the first restaurant to launch their subscription business a few years ago, where they offered customers unlimited coffee and unlimited soft drinks for $10 a month. And it absolutely took off. Now, you might be thinking, can't that make them lose huge amounts of money if they just started giving away something that they sell for $3.50 a cup and give people unlimited supply of that for $10 a month? That's literally taking a customer that could be worth $100 a month if they were buying those coffees separately and makes them worth $10 a month instead. The fascinating thing here is that their numbers show that instead of driving down their average revenue per customer, this drives it way up. Because while it is true that they spend less on the coffee or soft drinks that you give away, the real magic is what happens when consumers think they're getting lots of free value and amazing stuff from you. The numbers prove that customers on Panera's subscription visit 10 times more frequently and bring customers 1 in 5 times who aren't subscribers and spend 40% more on high ticket items like entrees than non-subscribers. This is invoking a really powerful thing in psychology called reciprocity bias, where when somebody feels like they're getting lots of great free stuff and amazing value, they end up wanting to reciprocate, in this case by spending more money on other things or using it more frequently, and that ends up driving massive additional revenue for Panera. They also give the restaurant a very predictable form of revenue in those loyal customer subscriptions. And because they selected free coffee to give away, which is an item that they maintain a less than 10% food cost on, they don't even lose money on the millions of cups they give away per month through their subscription program. This lesson also applies beyond just subscription programs, meaning that you can also take advantage of this in your restaurant's loyalty program. Here's how that works. You make sure it's structured around similarly very low food cost items, which enables you to reward guests every few orders for their loyalty and give them a huge amount of perceived value. Wow, I'm getting this $7 dessert for free, or wow, I'm getting this $7 appetizer for free, but without costing the restaurant much money in practice because you've selected intentionally low food cost items. There's a lot of research that shows that this not only increases the retention of customers, meaning that it's more likely for new customers to become regulars if they're getting free rewards from you every few transactions, but that those customers are also way more likely to spend more money per order and to refer their customers when they feel like they're getting that amazing value from you. What made Panera's use of subscriptions or free item giveaways wasn't just the strategies themselves. It's what's called first mover advantage. That's lesson 6, first mover advantage. Panera is always one of the first businesses to adopt innovations of restaurants. We saw it with their subscription business or with their loyalty program, and they were also one of the first restaurants to launch an app after that. With that app, they saw that customers that they could get to download it would order more than 50% more frequently and are that much more likely to opt in to both their subscription program and their loyalty program. You may be thinking, Adam, my independent restaurant can't even get an app, so why are you telling me this? The good news here, I've created a system which enables restaurants to have their own app for less than $500, which is practically guaranteed to grow sales of that restaurant. Because we've studied the best apps, including Panera and Starbucks, and we've taken the best parts of each. So if you want more details on that, on how your restaurant can get its own app that's integrated into the POS and into your loyalty program, then feel free to check out Owner.com. You're probably thinking, what opportunities are there for first mover advantage now? Panera's already done their own app and we're the first, and done subscriptions and we're the first. What I've now seen the most innovative restaurants adopting that is leading to incredible results is AI for search engine optimization, meaning training the ChatGPTs of the world to create pages on your website that are designed to rank for hyper-specific terms in each of the surrounding cities or for each of your menu items. This can lead to certain restaurant brands like Talkin' Tacos literally driving millions of dollars in sales. And the first mover advantage is still available because a lot of independent restaurants don't know about it. Lesson number 7, growing through generosity. From the beginning, Ron, the owner, knew that if he could develop a reputation for caring deeply about the people in his communities, that would not only serve his business well, but was the right thing to do and would help him attract talent. And they tried all sorts of things. Some of them didn't work, like the Community Cares cafes that they launched, where they gave away free food to anybody that wanted it and you could choose your own price. Those locations ended up struggling financially, but they ended up leading to a breakthrough that did work. The Day and Dough program was this brilliant initiative that Panera created where they would donate all of their fresh baked goods and bread to local nonprofit organizations at the end of each day. If you've been in a Panera Bread, you've probably noticed posters around this because they not only help their brand give back, but they make customers and employees feel good about the impact they're having through supporting the Panera mission. And they're now being able to serve millions of people a year through just donating what would otherwise be lost as food waste. Are there opportunities for this in your specific restaurant? Items that you'd otherwise have to throw away that you can partner with a local nonprofit on to give them and tell your team and your community about how you're supporting that nonprofit in order to develop a deeper reputation. Those types of programs help your restaurant do well by doing good. If you want to continue learning about some of the biggest secrets behind the most successful restaurants of today in 2025, I made a whole new compilation showing the biggest secrets behind the billion-dollar restaurant success stories of the past 20 years, including how Kava did it, how Sweetgreen did it, and other brands that literally made billions of dollars in this space. The wild thing is that they've each followed slightly different strategies, but there's tons that we can learn from each of those success stories. So if you're interested in checking out that video, I'll put it to the right of me now. I highly recommend it if you're interested in building a successful restaurant brand and want to continue learning about what is going to work in doing that.